This is the Alt Thinking Podcast by 9 Point Partners. Today, featuring the DeFi Decoded series in partnership with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hi, everybody. This is Alex. I'm back with Andrew Young here for our next episode of DeFi Decoded. Today, we're talking about another use case for DeFi, which has exploded in size, and that's the lending space. Now, anybody who's familiar with traditional financial services knows that lending or credit is sort of foundational, basically, to how our economy functions. And it's no surprise that it's obviously found great product market fit in the DeFi space as well. Andrew, why don't you give us a high-level overview of how the lending market has grown in the DeFi space?
Yeah, thanks, Alex. And obviously happy to be here again. Lending is actually the single biggest use case in the DeFi sector right now, when you measure it by total value locked or assets under management. Decentralized lending platforms essentially enable the lending and borrowing of crypto assets. And these lending platforms flip the traditional model on its head. So what I mean by that is that lenders and borrowers transact with each other through smart contracts. There are no intermediaries involved in the middle. This means that these what this has led to is that these lending platforms have grown tremendously over the last year. Like you said, they've truly found product market fit. The largest DeFi platform in the world is actually a lending platform, AAVE, which holds over $11 billion in assets by itself. On this episode, me and you are going to talk about the lending boom and sort of discuss how these lending platforms have become the dominant hub of DeFi. And we'll compare how these decentralized lending platforms like AAVE are different than their established centralized peers like BlockFi.
Interesting. And of course, there are the centralized peers, maybe not peers yet, but banks and other financial intermediaries. BlockFi, I guess, is sort of like the crypto version of a traditional financial institution, right? And these protocols like AAVE are disrupting that, and that's been a recurring theme through these podcast episodes. Is that DeFi is not only helping us reimagine traditional financial markets and use cases, but it's actually disrupting some of these fintech darlings that themselves are supposedly supposed to be the big disruptors. So that's very fascinating. So maybe just let's start from the beginning here, Andrew. How does a lending protocol like AAVE work exactly? How does it, in other words, let's say I'm a borrower, I want to borrow funds for whatever reason, and you're a lender, you're willing to lend me money in exchange for some rate of return. How does that work in practice inside of one of these protocols?
Yeah, I mean, it's a good question. Like I said, AAVE is a decentralized lending protocol that facilitates the lending and borrowing of crypto through smart contracts. So the way that actually works at the lower levels is the lenders, the users or whatever you want to call them, deposit tokenized assets or tokens into liquidity pools. So liquidity pools are essentially smart contracts that act as a sort of autonomous wallet that holds these assets.
Okay.
Those assets then become the funds that the borrowers can draw on. And the way that works is because there's no bank and the smart contracts, which are really just computer codes that are holding these tokens, the borrowers, there's no legal recourse like there is in a traditional lending system. So the reason why that matters is that means that all DeFi lending right now is over collateralized. So what I mean by that is that borrowers have to put up 150, say you're taking out a loan for $100, you would actually put up $150 of collateral in separate crypto. So what I mean by that is if I'm trying to borrow 100 USDC, which is $100, I would actually have to put up $150 worth of Ether tokens. And then that $150 acts as the collateral, which protects the borrower and allows me to draw the $100.
Yeah.
And I can talk about why users would. It seems like a kind of a weird way of doing lending and borrowing. So,
well, no, I mean, I think the first question people would have is, well, if there's no legal recourse and there's no bank and there's no contract, then what prevents the borrower from just walking away with the loan, right? And of course, the solution is that the loan is not only fully collateralized, it's actually over collateralized. So that way, that protects the lender. But it does raise another question, which is that normally people borrow money when they don't have it in the first place. Let's think of some common regular world examples. I want to buy a $500,000 house, but I have $100,000 down payment, so I borrow the rest. Or I want to buy a car. These are things people are familiar with. But of course, there actually are many instances in traditional financial markets where there are examples of loans that are fully or over collateralized. I mean, a mortgage in a sense is an over collateralized loan, right? Because if you default, the bank can seize your home, and the home is usually worth quite a lot. But in traditional financial markets, you can think about a margin account, for example, right? Where if I've got $100,000 portfolio, my bank will probably lend me, I don't know, 60 grand against that to invest. They'll allow me to leverage that up. And of course, if things go well, I can increase my return. And if things don't, then they always have those stocks that they can sell. And that's called a margin call. So let's talk about use cases for lending. It doesn't sound like there's a lot of DeFi mortgages. So what is this lending being used for?
Yeah, so the main reason is for speculation.
Right. For trading, right? Similar to sort of the margin account example.
Exactly. So the way it is essentially for leverage. That's like the key element there. You can also do it for shorting. But the main use case that we've seen so far is leverage. So to go back to my previous example, say I'm a user that I have a very bullish opinion on Ether, the price of Ether. And I don't want to sell my Ether, but I want to take more leverage on it. I would put up $150 of Ether as collateral to receive $100 of USDC. And then I would then use that $100 of USDC to buy more Ether. So now in effect, I'm long $250 of ETH with only $150 of collateral. Obviously that's quite limited in terms of the amount of leverage you can get, but for the vast majority of people, that sort of fits the requirements of what they're looking for.
Well, it's an interesting question because I can go to a cryptocurrency exchange and get more than 50% or whatever, 75% leverage, right? I mean, I can take positions in the market that with derivatives and through other means that would allow me to get massive leverage. So where are we seeing? Why is it that people are using these kinds of protocols versus centralized exchanges?
Yeah, I mean it's a really good question. The first, I think the fundamental benefit of anything in DeFi is that it's all non-custodial. So what I mean by that is you're not taking the traditional counterparty risk of using a custodial platform like BlockFi. So just to give an example, BlockFi is a centralized crypto lending platform. And with a custodial platform, you have to actually deposit assets onto the centralized company's wallet and essentially just hope that they don't go bankrupt or default or anything like that. So you're taking counterparty risk.
Yeah.
With DeFi, there's no counterpart. There's the counterparty risk. I shouldn't say there's no counterparty risk. The counterparty risk is different. So you're trading counterparty risk with a centralized company with protocol risk. And we can dive a little bit into that. But essentially that's, I guess, cybersecurity risk in a way, where you're hoping that the smart contract itself doesn't get hacked. And then finally, and we can talk more about that, but the second big reason why people use DeFi is that it's anonymous. So it's got privacy benefits. There's no, you don't have the typical KYC requirements and sort of regional restrictions that you may have with traditional lending and borrowing platforms. And that allows you to take large lending positions and stuff like that. And then finally, the third key element I would say is that DeFi is composable. So what I mean by that is it's kind of hard to explain, but these protocols are actually all connected to each other. So I can take out a loan on AAVE and then use that loan to essentially secure other assets or use it as collateral for other assets. So
right.
It sort of allows like some rehypothecation of your collateral. which is kind of interesting.
Yeah. You're a student of economic history, and we've gone through various cycles of credit expansion and contraction. I think people refer to the financial crisis as the credit crisis, or was originally, right? And I wonder, can you imagine a scenario where because of, I guess it would be the decline of the value of the crypto assets that's being pledged, that there could be a contraction of credit. So the scenario is, I've got crypto, I borrow against that crypto, I use that amount that I borrowed to become an LP in another DeFi project, that someone then borrows against that to do the same thing. And this sounds like kind of a shell game, but that's actually how the economy works normally, right? Like people take out a loan, they buy a house, the house goes up in value, they take out another loan, they buy a car, the car has debt on it, et cetera, et cetera. And that's an expansion of credit, and then there are contractions of credit. So we've been through some pretty volatile markets here the past little while. How have these things held up, I guess, is the question. Have we seen any of that sort of contraction? Because we've obviously seen a lot of growth.
Yeah, no, it's a really good question. So far, things have actually held up reasonably well. The main thing that's led to so the way the process works to protect lenders is first there's the over collateralization ratio, like we talked about, and then what there is there's essentially this liquidation system where to go back to the previous example, if my $150 of Ether goes below a certain ratio, so say it gets to $105 of Ether, as the price of Ether goes down, someone will come in and liquidate my position to protect the borrower.
Right.
And historically, what's happened where this sort of the system works quite well. There's certain situations where it doesn't. And the main situation is Oracle risk. So what I mean by that is Oracle is essentially a data feed. It's another word it's the crypto version of a data feed. And so the data feed that supplies the prices, which determines whether a loan should be liquidated.
Yeah.
If that data feed breaks down for any way, which has happened occasionally, then the whole system sort of breaks, and you can get under collateralized loans. And that actually happened with the MakerDAO stablecoin system about a year and a half ago, which is sort of has the same sort of mechanisms. And it actually led to there being essentially under collateralized loans. And the way these systems sort of step in to backstop this scenario is they have their own protocol tokens. So like AAVE, for example, has the AAVE token, and MakerDAO has the MKR token. And so the way those tokens work is they sort of act as almost like a decentralized insurance fund to sort of capture and backstop the system when things break.
And that itself is also decentralized, the insurance system as well. It's amazing because a lot of these, anybody who is in the traditional financial markets will appreciate that these kinds of systems and backstops exist in traditional markets, but they're usually companies that are the counterparties, right? Or securities markets. Sometimes, loans are collateralized. So let's say that, now I'm trying to think, I get now why I'd want to be a borrower on the system. Now, why would I want to be a lender? So if we think about the rate of return I can get, in my high yield savings account, it's basically zero. But I can buy bonds, or I can buy dividend yielding stocks. I suppose there's some equity risk there, but I can get a return of a few percent a year. Why would I do this? Are the returns better in the decentralized space?
Yeah, for sure. The returns are greater in the DeFi space, and that's why so many people are using these DeFi platforms nowadays. And what I mean by that is, I'm just looking at the AAVE website right now. For example, you can actually deposit certain assets, and we're actually in a down cycle right now, which is typically where deposit rates take a big fall. But you can still get between 5 and 30% annualized yield on your tokens.
Jeez.
And that's on the largest and I guess quote unquote safest platforms. If you start venturing out into, and again, all of these loans are over collateralized, so your risk to a certain extent is quite low. And if you start venturing out into like these lending platforms on non-Ethereum networks, so for example, AAVE has a platform on the Polygon network, and there's other lending platforms like EasyFi and among many others. And the rates of return just go even higher.
And why is that? Is that basically what you were talking about? It's protocol risk, because we know it's not counterparty risk in the traditional sense. I mean, if they have the same level of collateralization, is it just like Aave? I know it. It's on Ethereum. You know, the guys are on Twitter. They're real people, and then you know, the farther away you get from that, the more you want to be compensated, basically for dealing with a lesser known entity. Is that it?
Yeah, sorry, I missed the last part, but yes. So exactly. So the rates of return are greater, exactly like you said, because of protocol risk, and also just the fact that there's these opportunities are more complex. So lending on a lending platform on Polygon, not as many users are aware of how to use the Polygon network versus using something like Ethereum, and that's why I think. And then also just liquidity fragmentation. So there's more.
You might have to explain what that means.
So it's simply just a less crowded trade, if you want to call it. So,
right.
Yeah. So what I mean, again, going back to the previous reasons, liquidity on Ethereum is quite concentrated, whereas lending liquidity on these new platforms can be more spread out across a number of newly emerging, I guess, competitors. So there's not as much, I guess, concentration within these new networks because the markets are, I guess, more up for competition and new entrants. I mean, I guess I have a couple of questions too. I mean, I think, how do you think about DeFi and lending within the broader traditional financial system? Like obviously you've written a lot about DeFi in the traditional banking sector. I'm just kind of curious how you think of, do you see banks kind of using these DeFi products over the next 12, 24, 36 months?
Yeah, I think that it's worth keeping all of this in perspective. Aave's got 11 billion of TVL, which is a lot of money, but compared to, you know, the balance sheets of even a small bank, that's actually not that much money. But I think that what matters is not the size, but the rate of change, right? That we started at 0 a year and a half ago, and now we're at almost 100 billion across all these different protocols. And, you know, in certain ones like in Uniswap and Aave and others, you know, we're 10 billion plus. So, you know, it's like the Gretzky quote, you skate to where the puck is going, not to where the puck is today. So my view is that banks ought to be paying attention to what's happening here. And I think that there's probably a lot that they could glean from this. I think there are probably regulatory constraints to them actually embracing DeFi as it exists today. For one, you know, they need to do KYC and AML on customers. So you can't have an anonymous customer borrowing money, you know, through the bank. The bank itself, I'm not sure what they would be. I guess they would be a liquidity provider, right? They'd be provisioning capital. I think we're probably a ways away from that. But you know, things can happen faster than you think, right? So, for example, BNY Mellon, Chase Manhattan Bank are going to start custodying crypto assets soon. If you think about, you know, most custodial banks and large asset managers, they make a lot of their money lending out stock, right? So what happens when these banks are, you know, custodians of large amounts of crypto assets? Maybe they ought to be lending it out in exchange for rate of return. Now, maybe they want to do that in the more traditional centralized way, but they could just as easily give it a shot on some of these DeFi platforms, right? So I think the constraint is not technological. It's not really even commercial. It's really regulatory, which is whether or not they'll be allowed to do that kind of stuff. But certainly if I was, you know, in a bank in a low interest rate environment, you know, they make their money on the net interest margin, right? What you borrow versus what you lend at. This is obviously quite attractive, earning 30% returns. Just like lending Tesla shares at, you know, a 20% borrow rate or whatever it is very, very attractive if you're sitting on a bunch of that too, right? So we'll see. I think that It's something they ought to become very knowledgeable about now. And I think over time, we'll find that there are lots of business use cases for it. So why don't we talk about AAVE Arc, which is an institutional DeFi platform that they just announced. Who's that catered to?
Yeah, so AAVE has sort of recognized, I guess, the change in winds within DeFi in the sense of DeFi is becoming more and more mainstream, and trying to target those more institutional investors, and sort of trying to create a DeFi platform that fits their requirements. So AAVE Arc, which was initially launched as AAVE Pro, but just rebranded actually a couple of days ago, is essentially an institutional DeFi platform where everyone in the system would be fully KYC'd, and it'd be tailored strictly to institutional financial institutions. Financial institutions. And I think the idea is there would also be kind of like a higher level of security. It would focus on liquidity within the major assets. So what I mean by that is it would only have liquidity pools for Bitcoin, Ethereum, USDC, and their AAVE token. And the system would be totally segregated from the more, I guess, traditional retail platform. And
wow, that's fascinating. I've just heard about that today from you. That's pretty interesting development.
Yeah.
Well, I mean, we know that there are lots of, crypto hedge funds and other sorts of crypto native institutions that would probably love to get all over this because they're regulated entities too, a lot of them, depending on where they're domiciled. I don't know yet. Certainly that's like a necessary but not sufficient step towards, I think, broader institutional adoption. But I mean, AAVE obviously understands that there's, an opportunity there. I do wonder though, and I'm aware of our timing here, but this is such a great chat. Aren't AAVE and Uniswap and these things supposed to be decentralized? So, who's making these decisions exactly? And doesn't that point to sort of some level of management and coordination?
Yeah, so what's interesting about this is that it's a segregated pool, but it's still governed and sort of backstopped by the decentralized AAVE governance.
Okay.
So the way, I mean, it's still kind of scant on details, but the way that I sort of imagine it would be set up is that AAVE Labs, I believe, which is the company behind the AAVE protocol, will be sort of, I guess, shepherding and managing and kind of operating the AAVE Arc system. But the sort of final decisions around what assets to include, the insurance, or I guess backstop, and kind of the governance of the system will still be determined through the AAVE governance system, which is controlled by the AAVE token. So it's kind of an interesting, I mean, it's kind of up for debate whether that system will work, but it's sort of like an interesting dual hybrid system. And yeah, curious to see how it plays out.
Well, I think we're all curious to see how most of this plays out. But, I think it's worth pointing out that a lot of these decentralized protocols have been through ups and downs, and they're really battle tested, right? And, I mean, when the stuff hits the fan in traditional markets, there's always the government to backstop the banks who behave badly. But in this industry, there isn't. It's sink or swim. And so far, they've all managed to continue to swim, at least the big ones that we know about. So in my view, that bodes really well for the technology and its usefulness down the road. All right, well, that concludes today's episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. Thanks for joining us. We'll see you again next week. Bye, everybody.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.